Hello all. So in today's third session on various purposes of valuation, we are going to cover concepts, theory, formulas, along with examples and case studies on long-term capital gain valuations. So this theory part, which carries 4 marks as per IBBI syllabus, has already been covered in session number 1. This part we have covered in session number 1, and this part we have covered in session number 2. So in today's session we will cover capital gain methods, examples, case studies, and in next session we are going to cover cost index method, examples and case studies. So before we will start calculating examples and numericals on long-term capital gain, let us understand difference between short-term and long-term capital gain. Short-term capital gain, if property is held for a period up to 3 years, then it leads to short-term capital gain. However, if property is sold after being held for a period more than 36 months or 3 years, it leads to long-term capital gain. So property should be kept or sold after 3 years. So if a property is being sold at exactly 3 years, it leads to short-term capital gain, not a long-term capital gain. Base year and base date. So there are few concepts which I'm going to discuss in 2-3 slides. So if we will understand these 3-4 concepts, then any capital gain valuation we can solve. Normally people find it very difficult to establish or to calculate these type of numericals because you need to have very good clarity on the concepts. So please try to understand these 2-3 slides, because if you will not be able to understand these 2-3 slides, you will not be able to solve any problem, and there is a high chance of getting error in the numerical. So first concept, whenever you find a problem on capital gain, first of all, as a valuer or IBBI aspirant, we have to find out what is the base year for valuation. So how to define it, how to find out? If property is sold, it is on or before 31st March 17, so it is an important date. So first of all, whenever we get a property valuation exam, question exam, try to write down the date of sale. If date of sale is 31st March 17 or less, then base year for valuation will be 1981, or exact date is 1st April 1981. However, if property is sold after 31st March 2017, then base year for valuation will be considered as 1st April 2001 or 2001. So if property is sold exactly on 31st March 17, then base year will be 1481. So please note down this slide, because this slide is going to help us in solving the problem a lot. So once we decide base date of valuation, then we have to calculate, next step is to calculate cost of acquisition or cost of improvement. So once base date of valuation is known to us, then we have to see whether the property was actually acquired before base date of valuation or after base date of valuation. So if, say for example, in any particular case, base date of valuation is 1st April 1981, which we decided based on previous slide. So we have to see the property whose capital gain assessment or valuation is to be done was actually acquired by the assessee before 1st April 81 or after 1st April 81. So if it was done before base date, before 1st April 81, then cost of acquisition or cost of improvement will be equal to fair market value as on base date of valuation, that is this one. Fair market value as on 1st April 1981. One figure we have to calculate or estimate this figure, or actual cost of acquisition or improvement, whichever is higher. For example, the property was purchased in 1975 at a cost of say 5 lakh rupees, at a consideration of 5 lakh rupees. However, the actual fair market value of the property as on 1st April 81 was 10 lakh rupees. So then 10 lakh is higher than 5 lakh. So that means cost of acquisition of this property for capital gain evaluation purpose will be considered as 10 lakh rupees. If property was purchased or improvement was done on or before base date of valuation, that is on or after base date of valuation, which is 1st April 81 or 1st April 2001, based on previous slide discussion. So in those cases, cost of acquisition or improvement will be equal to actual cost of acquisition or improvement. So here fair market value concept will not work. So whatever is the actual cost of acquisition, that we have to consider is equal to cost of acquisition. Please note down this thing. If purchase was done exactly on the base date, 1st April 81 or 1st April 2001, in that case we have to use this formula, second formula. Please note down this, remember this thing, very important. So after we calculate cost of acquisition in second step and cost of improvement, then we have to calculate indexed cost of acquisition or indexed cost of improvement using these two formulas. So indexed cost of acquisition is equal to cost of acquisition multiply with CII, cost index, cost of index on date of sale, divided by CII for base year for valuation or CII for actual year of acquisition, whichever is later. So cost index for base year, which we calculated in second last slide, or CII for actual acquisition, actual year of acquisition, whichever is later. This is the cost of acquisition, index cost of acquisition. And index cost of improvement, likewise, cost of improvement as calculated in second step multiply by CI cost index as on date of sale divided by cost index for base year for valuation or cost index for actual year of acquisition, whichever is later. So these are the three slides based on which we can solve any capital gain valuation. So once we calculate index cost of acquisition and index cost improvement, then taxable capital gain is equal to sale consideration minus index cost of acquisition minus index cost of improvement. There could be some other reductions also like brokerage, etc. But in majority of questions, these two items will be required to deduct from sale consideration to arrive at the taxable capital gain from IBBI exam purpose. And capital gain tax slab, normally it is given in the question. However, if it is not given, examiner may ask you and may tell you that Mr. X purchased the property and sold the property and he is an individual. So we have to use 20% formula for capital gain tax slab. If the buyer or seller of the property is a company, is not an individual but a company, then applicable capital gain tax on that capital gain amount, this taxable gain amount is equal to 40%. 40% of the taxable gain amount has to be paid by the company to Government of India in the form of capital gain tax. So these are the four main slides based on which you can crack any numerical or case study which may come up to 12 marks in IBBI exam. So let us try to apply these formulas under various scenarios and let us try to understand these concepts. Simple concept, but there could be a number of scenarios. So we'll repeatedly use these 2-3 formulas under different scenarios. Different base date, before base date purchase, after base date purchase. So there could be a number of scenarios. So first example, Rahul purchased a flat in 2001, financial year 2001 for rupees 10 lakh rupees. He sells the flat in 2017-18. Cost index for financial year 2001-2 and financial year 17-18 were 100 and 272 respectively, what will be the indexed cost of acquisition. So 1 mark or 2 mark numerical may come similar to these questions. As I always say, before solving the problem, we always have to note down the data given in the question, whether it is relevant for solving the problem or not. So try to write down the data in your own chronological order and in your own language. So date of purchase given in the question, it is exact date is not given, but year of purchase is given, which is equal to 2001, financial year 2001-2. So that date of purchase is after 1st April 2001. Amount of purchase, amount of acquisition 10 lakh rupees. Date of sale is given, financial year 2017-18, that is after 1st April 17. Cost index for 2012 is given 100, and cost index for 2017-18 given as 272, and index cost of acquisition we have to calculate. Since flat, so first step, since flat was sold after 31st March 17, so what is the base date? On or before 31st March 17, the base date was 1st April 81. However, here the flat has been sold after 31st March 17, so base date for valuation is 1st April 2001. If you will not able to understand this concept and you consider wrong base date, entire numerical will get spoiled. You will not be able to score any marks. So this is very important concept. After you decide on the base date, then we have to see whether the flat was purchased before base date or after base date, this date. So since the flat was purchased after base date of valuation, so here flat was purchased in financial year 2001-2, so that means after 1st April 2001, right, on or after base date. So that means cost of acquisition is equal to actual cost of acquisition, which is given in the question, is equal to 10 lakh rupees. So that means index cost of acquisition is equal to cost of acquisition multiplied by cost of year of sale, cost index for sale year, and cost divided by cost index for acquisition year, whichever is later. Since here acquisition year is later one, so we have considered this. So that means 110 lakh multiplied by 272 is a cost index for sale year given in the question, and cost index for acquisition year 100 is equal to 27.20 lakh is the answer to this question. Case study, it carries 12, it may come for 12 marks. On 7 December 1989, a property was acquired by Mr. X for rupees 8.08 lakh. In June 1992, improvements were done for 12.056 lakhs. On 10 December 14, the property was sold for rupees 1.93 crore. CII 172, 223 and 1024 are given for financial year 1989 to 90, financial year 92-93, financial year 14-15 respectively. So we have to calculate index cost of acquisition, index cost of improvement, total index cost, taxable capital gain, and capital gain if Mr. X is an individual, and capital gain if Mr. X is a company. So we'll try to apply all the concepts which we discussed in previous 3-4 slides. So first, as I have told you, always write down date of sale. So property was sold on 10 December 14 at a cost of 193 lakhs, 1.93 CR, which is equivalent to 193 lakhs. Property was purchased on 7 December 1989 at a consideration of 8.08 lakhs, and then improvements were done in June 1992 at the rate of 12.06 lakhs. Cost index for 3 years has been given, 1989 which was year of acquisition, 92-93 year of improvement 223 cost index, and year of sale cost index is given as 1024. So first of all, we have to decide on the base date, and for deciding upon the base date, we have to see what was the exact sale date. So here property was sold on 10 December 14, which was on or before 31st March 17. So since property was sold on or before March 17, so base date for valuation will be 1st April 81. In previous example, base date was 1st April 2001, since property was sold after 31st March 17. But here property has been sold before 31st March 17, so base date has changed from 1st April 2001 to 1st April 1981. Since the property was acquired, after deciding on the base date of valuation, we have to see when the property was acquired. Since the property was acquired on or after 1st April 81, so that means cost of acquisition is equal to actual cost of acquisition, which is given in the question, is equal to 8.08 lakhs. Also, improvements were done in June 1992, that is on or after base date for valuation. Again, both acquisition and improvement both have been done after base date. So here cost of improvement again will be equal to actual cost of improvement, which is equal to 12.06 lakhs. Now, after deciding upon base date of valuation and cost of acquisition and cost of improvement, we have third step is to calculate indexed cost of acquisition and indexed cost of improvement. So we have already understood the formula. So indexed cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year. Numerator will always remain same, and cost index for acquisition year or base year, whichever is later. Let me repeat. So here acquisition year is later than the base year. So index cost of acquisition is equal to 8,008 multiplied by 1024 and divided by 172 is equal to 48.10 lakh is the index cost of acquisition. It is the answer to question number 1. 2 marks done. Then we have to calculate index cost of improvement. Same formula. Since improvement was also done after base date, so cost of improvement multiplied by cost index for sale year divided by cost index for improvement year, because improvement year is later than base year for valuation. So here also it is both base year cost index for sale year and cost index for improvement year. These cost index have been given in the question. That means cost index for improvement is equal to index cost of improvement is equal to 12.06 lakhs multiplied by 1024 divided by 223. It is equal to 55.38 lakh. It is answer to question number 2. Now that means total index cost of property is equal to index cost of acquisition plus index cost of improvement, that is equal to 48.1 lakh plus 55.38 lakh. It comes to 103.48 lakh is the total index cost of the full property, and it is answer to question number 3. 6 marks done. Then taxable capital gain is equal to sale price minus index cost of property. Sale price has been given in the question. Index cost we calculated in the last slide. So that means 193 minus 103.48 lakh is equal to 89.52 lakh is the taxable capital gain of the property. Then capital gain tax, if Mr. X is an individual, 20% of this amount, 89.52, it comes to 17.90. It is answer to question number 5. And if Mr. X is a company, then capital gain tax will be equal to 40% of taxable capital gain, this amount. So that means 35.80 lakh is answer to question number 6. Another case study. So case studies will be similar, but we will try to understand different scenarios with the help of these case studies. The property was acquired before base date, after base date, different base dates. So these type of questions may come. So we have a set of case studies to elaborate you know how to solve numericals under different scenarios. So all these questions appear to be very similar, but there is a fine difference between all these case studies in terms of establishment of their base date. On 9 January 19, Mr. X acquired a property for rupees 9.49 lakh. In August 92, improvements were done for 14.76 lakh. On 17 December 2014, the property was sold for 197 lakh. CIA for 89, 90, 92, 93 and 14, 15 are given as 172, 223 and 1024 respectively. Again, we have to calculate same data. Index cost of acquisition, index cost of improvement, index cost of property, taxable capital gain and capital gain if Mr. X is an individual, Mr. X is a company. So if we are able to find out exact base date of valuation and actual cost of acquisition and improvement, then we will be able to solve all these questions. So data given in the question is property was sold on 17 December 14 at the rate of 197 lakhs. Property was purchased on 9 January 90 at a cost of 9.49 lakhs, and improvements were done in August 2092 at a cost of 14.76 lakh. Cost index for acquisition year, from improvement year, and for sale year have been given here in the question. So first we have to find out base date for valuation, for which we need to see what was the actual date of sale of the property. Since the property was sold on 17 December 14, that is on or before 31st March 17, so base date of valuation is 1st April 1981. This is done. After we have got this base date, then we have to see whether the property was acquired before this date, base date, or after the base date. Since the property was acquired on 9 January 1990, which is on or after base date, so after on or after base date for valuation, so that means cost of acquisition is equal to actual cost of acquisition, which is given in the question, is equal to 9.49 lakhs. So improvement were also done in August 92, that is on or after base date, so cost of improvement is also equal to actual cost of improvement, which is equal to 14.76 lakh. Now index cost, this is the same formula which we used in the previous example. So index cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year, cost index for acquisition year, 9.49 multiplied by 1024 divided by 172, it is equal to 56.450 lakh is index cost of acquisition, and index cost of improvement is equal to same cost of improvement given in the last slide, we have given it in the last slide, and these cost index for sale year and cost index for improvement year have been given in the question. So this is the 67.92 is the index cost of improvement, and this is the answer to question number 2 of the question. Then total index cost is simply sum total of index cost of acquisition plus index cost of improvement. So 56.50 plus 67.92 is equal to 124.42 lakhs is the total index cost of the property. Taxable capital gain, sale price minus total index cost. Sale price has been given in the question. This we have given in the last slide. So that means 197 minus 124.42 is equal to 72.52 lakh is the taxable capital gain on the property. If Mr. X is an individual, then 20% of this amount has to be paid in the form of capital gain tax. It is equal to 14.52. Answer to question number 5. And if Mr. X is a company, then 20% of this amount has to be paid in the form of capital gain tax, which is equal to 29.3003 lakhs is answer to question number 6. Another case study for 4 marks. On 10 October 1982, Mr. X acquired a property consisting of 3000 square feet of plot and 4500 square feet of built up area in Chennai for a cost of rupees 10 lakh. On 6 February 2007, he sold his property for a sale consideration of 200 lakhs or 2 crore. CII for 82-83 financial year and financial year 16-17 are 109 and 1125. Calculate index cost of acquisition and capital gain. Data given in the question: property was sold on 6 February 2017 at a cost of 2 crore rupees, and then property was acquired on 10/10/82 at a cost of 10 lakh rupees. So plot area given in the question, built up area given in the question, and cost index for a year of acquisition and year of sale have been given in the question, equal to 109 and 1125. Again, first we have to see what was the actual date of selling the property. It is given in the question as 6 February 17. Since property was sold on or before date of 31st March 17, it is a very important date. So base date for valuation is 81. Had this property was sold after 31st March 17, then base date for valuation would have been 1st April 2001. But here it has been sold before 31st March 17. Thus base date for valuation is 1st April 81. Now the property was acquired on 10 October 82. That is on or after base date. That means cost of acquisition is equal to actual cost of acquisition, which is equal to 10 lakh rupees. And likewise index cost of acquisition is equal to then index cost of acquisition is equal to, here improvement is not given in the question, so there is no discussion on improvement, only acquisition cost is given. So thus index cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year divided by cost index for acquisition year. Since acquisition year is later than the base year, base date for valuation year. So 10 lakhs multiplied by 1125 CII for sale year divided by 109 CII for acquisition year, it is equal to 103.29. It is answer to question number 1. And capital gain is nothing but sale price minus index cost. So sale price has been given in the question, 2 crore rupees, 200 lakh rupees, and index cost we have here total index cost. So that means the owner of this, the seller of the property will get a capital gain of rupees 96.7 lakh under this scenario. If he is an individual, he has to pay 20% of this amount as capital gain tax. If he is a company, then 40% of this amount has to be paid in the form of capital gain tax. Next case study, Mr. X acquired the property in June 1990 for rupees 12.05 lakh. On 10 December 2014, he sold the property at 85.14 lakh. Index cost for 1991, 2014, 15 has been given as 1024 respectively. Cost index cost of acquisition, and taxable capital gain we have to calculate. 4 marks question. Property was sold on 10 December 2014 at a cost of 85.14 lakh, and property was acquired in June 1990 at a cost of 12.05 lakh. Cost index for a year of acquisition and year of sale has been given. So here property was sold on 10 December 14, that is on or before 31st March 17. Thus base date for valuation is 1st April 1981. We will see few examples of other base date also in subsequent slides. Since property was acquired, and the second step is that whether the property was acquired before base date or after base date. So here property was acquired on 10 October 1982, which is on or after base date of valuation 1st April 81. That means cost of acquisition is equal to actual cost of acquisition, which is given in the question, equal to 12.05 lakhs. Thus index cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year divided by cost index for acquisition year. Both these cost indices have been given in the question. So 12.05 lakh multiplied by 1024 cost index for sale year divided by cost index for acquisition year or cost index for base year for valuation, whichever is later, if you remember the formula. So since here acquisition year is later than the base year, so we do not need cost index for base year. So cost index for acquisition year has been given in the question. So it is equal to cost index cost of acquisition is equal to 67.80 lakh. Thus capital gain is equal to sale price minus index cost. Sale price has been given in the question, equal to 25.14 lakh minus index cost of property, which is this 67.80 lakh. Thus capital gain, taxable capital gain of this property to the seller is 17.34. If seller is an individual, he will pay 20% of this amount as tax. If seller is a company, he will pay 40% of this amount as in the form of capital gain tax. Next question. An individual owned property was originally acquired on 1st October 1972 for rupees 1.02 lakh. The fair market value of the property on 1st April 1981 was 5.25 lakh. On 10 December 14, this property was sold for a sale consideration of 75.05 lakh. 100, 1024 are cost index for 1982 and 2014-15 respectively. Calculate index cost of acquisition and taxable capital gain. So here data given in the question is property was acquired on 1st October 1972 at a cost of 1.02 lakhs. Then fair market value of the property as on 1st April 1981 has been given as 5.25 lakhs, and property was sold on 10 December 14 at a cost of 75.05, and cost index for 81, 82 and 14, 15 has been given 182 and 1024. First we have to see what was the date of sale. So here in this question, date of sale is 10 December 14, which is on or before 31st March 17. That means base date of valuation is equal to 1st April 81. Number 1 step. Step number 2, whether property was acquired before base date or after base date. Since the property was acquired on 1st October 1972, sorry, so which is on or before the base date for valuation. Before base date of valuation, so that means cost of acquisition is equal to actual cost of acquisition or fair market value as on base date of valuation, whichever is higher. So both these figures have been given. 1.02 was the actual cost of acquisition, 5.25 has been given as fair market value on the base date of valuation. So here cost of acquisition will not be equal to actual cost of acquisition. However, it will be equal to fair market value of the property as on base date of valuation, which is 1st April 1981. So once we have decided upon cost of acquisition, which is 5.25 lakh, we can easily calculate cost index for acquisition using this formula, which we have already discussed in previous slide. So here cost of acquisition multiplied by cost index for sale year, which always remains same under both the formulas. However, in base, cost index for base year will be taken, because here acquisition was done in 1972 and base year is 81. So since base year is later, year of acquisition or base year, whichever is later, so we have to take out cost index for the year whichever is later. So here base year is later than the acquisition year. So index cost of acquisition is equal to 5.25 lakh multiplied by 1024 divided by 100. It is equal to 53.72 lakhs is the index cost of acquisition. Thus capital gain is equal to sale price minus total index cost, which is equal to, this is given in the question, 75.05 lakh. This we have calculated 53.56 lakh. So 21.29 lakh is the taxable capital gain of the property. Answer to question number 2 of the question. Next case study. On 12 December 2010, a property was acquired by Mr. Y for 75.28 lakh. On December 2014, the same was sold for 103 lakhs. 711-1024 are cost index for 2010-11 and 2014-15 respectively. Calculate cost index cost of acquisition and capital gain. Here property was sold on 10 December 14 at a cost of 103 lakhs and property was acquired on 12 December 2010 at a cost of 75.28 lakh. CIA for 2010-11 year of acquisition and CIA for 14-15 year of sale has been given in the question. So first we have to check what was the date of sale of the property. It is given in the question that the property was sold on 10 December 14, that is on or before 31st March 17. Thus base date for valuation is 1st April 81. Now we have to see whether the property was acquired before base date or after base date. So here the property was acquired on 12 December 10, which is on or after base date 1st April 81. Thus cost of acquisition is equal to actual cost of acquisition, which is given in the question, is equal to 75.28. Now index cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year. Since here acquisition year is later than the base year, that means divided by cost index for acquisition year. So all these three figures have been given in the question, is equal to 108.42 lakhs is the answer to question number 1 of part 1 of question. 2 marks done. Capital gain is equal to sale price minus total index cost. So sale price has been given in the question and capital total index cost here is 108.42. So here the catch is that total index cost is more than the sale price. So here there will not be any capital gain, rather there is a capital loss to the seller. So there is no liability of paying tax on it. A flat was purchased in 1981 for rupees 2.4 lakhs. As a gift from his uncle, the assessee received this flat having an area of 80 square meter in June 2001. However, the assessee started using the flat in 2000 only. So in 2000 he started using the flat. However, he got the flat registered in his name, transferred his name in June 2001. In 2005, he carried out major improvements in the flat to the extent of 15 lakh rupees. He sold the flat in February 18 for rupees 240 lakhs. Prevailing rate of similar ownership in locality in June 2001 was 40,000 per square meter. The assessee paid society transfer charges of rupees 50 lakhs and brokerage charges of 1 lakh rupees at the time of sale. Calculate index cost of acquisition, index cost of improvement, total deduction, capital gain and capital gain tax at the rate of 20%. Cost index for these 3 years have been given in the question 117 to 22. So data given in the question, lot of data is given. So uncle actually purchased the flat in 1981 at a cost of 2.40 lakh. Assessee got possession of the flat from his uncle in 2002 in year 2000. However, the assessee got the flat transferred in his name from his uncle in June 2001. So he got possession in 2000, but he got transferred, title got transferred in June 2001. Assessee got improvement of 15 lakh rupees in the flat in August 2005. Assessee sold the flat in 2018 at a cost of 240 lakh rupees. Area of flat given in the question is 80 square meter. Society transfer charge is 50,000 rupees. Brokerage 1 lakh rupees. And prevailing rate of the flat in June 2001 is 40,000 rupees per square meter. And cost index has been given as this. So first we have to see, since the assessee, again we have to see when the flat was sold. So actually the flat was sold in 2008. That is after 31st March 17. That means base date of valuation is 1st April 2001. So it is important. First step. Always follow this step only. So then we have to see whether the flat was acquired before base date or after base date. Since the assessee got transferred title, property title transferred in his name in June 2001. No matter that he got its possession in 2000 and his uncle purchased the flat in 1981. So these two facts will not be important in this question. However, the assessee, existing assessee, the seller got title of the flat transferred in his name in June 2001, which is after base date of valuation, which is 1st April 1. So base date is April 1 and title got transferred in June 2001. So here cost of acquisition is equal to deemed actual cost of acquisition to assessee, that is fair market value of the flat as on date of transfer. So here actually he has not paid any amount. The assessee or seller has not paid any amount to his uncle. He has got this amount, has got his property in the form of gift. So on the date of gift, registry of the gift deed, execution of gift deed, what was the fair market value of the property? It was area of the flat given in the question, market rate in June 2001 has been given in the question, it is equal to, so actual fair market value of the flat as on June 2001 was 32 lakh rupees. So cost of improvement is equal to actual cost of improvement 15 lakh rupees, since these two things both have been done after base date. Now index cost of acquisition is equal to cost of acquisition multiplied by cost index for sale year and cost index for acquisition year. Since here acquisition year and base year both are same here in this case. So 32 lakhs cost of acquisition, which we calculated in last slide, multiplied by 272 cost index for sale year divided by cost index for base year and acquisition year. Here transfer year both are same, so 100. So 87.04 lakh is the index cost of acquisition in this case. Then index cost of improvement will be equal to cost of improvement multiplied by cost index for sale year 2018 and divided by cost index for year of improvement or base year, whichever is later. So here in this case actual year of improvement was 2005. So cost index for 2005 was 117, sale year 272, 15 lakh rupees has been given in the question. So index cost of improvement is 34.87 lakh. Thus total index cost is this plus this. Index cost of acquisition plus index cost of improvement is equal to 121.91 lakh. Total deduction is equal to total index cost of the property plus other expenses as per section 48(1). Please remember this section, 1 mark theory question may come out of it. So 121.91 lakhs as we have calculated in last slide. Index cost of acquisition plus index cost of improvement plus brokerage has been given in the question, plus society transfer charges are also allowed as per section 48(I). That is equal to 121.91 lakh plus 1 lakh of brokerage and 50,000 rupees of society transfer charges. So the total deduction allowed in this case is equal to 123.41 lakh. So capital gain is equal to sale consideration minus total deduction. 240 lakh is the sale consideration given in the question. Total deduction we have calculated here. So that means taxable capital gain is equal to 116.51. So if since the assessee is an individual given in the question, so 20% of this amount capital gain tax, taxable capital gain, is the capital gain tax liability of the assessee, which is equal to 23.32 lakhs. On 4 January 2005, a property was acquired by Mr. X for rupees 8.08 lakh. In June 2010, improvements were made for rupees 12.06 lakh. On 28 August 2018, the property was sold at 83 lakhs. Cost index for 2004, 5, 10, 11, 18, 19 have been given here, 113, 167, 280 respectively. And we have to calculate index cost of acquisition, index cost of improvement, total cost of acquisition and improvement, taxable capital gain, tax to be paid by Mr. X, and if property is owned by company, what is the capital gain tax? So any 1, 2, 3 or maybe all such question can come in any of the case study in exam. Data given in the question: property was sold on 28 August 18 at the cost of 83 lakh rupees. Property was acquired on 4 January 5 at a cost of 8.08 lakhs, and improvements were done in June 10 at a cost of 12.06 lakhs. CII given in the question. Again, first we have to see what was the date of sale. Here, date of sale was after 31st March 17. So base date for valuation will be equal to 1st April 2001. Now we have to see whether the acquisition and improvement were done before base date or after base date. Here, property was purchased after base date, 1st April 1. That means acquisition, cost of acquisition is equal to actual cost of acquisition, and likewise cost of improvement is equal to actual cost of improvement. Both are given in the question, 8.08 lakhs and 12.06 lakhs. Thus index cost of acquisition is equal to index cost to cost of acquisition multiplied by cost index for sale year divided by cost index for acquisition year, since it is later than base year. So 8.08 lakh multiplied by 280 divided by 113, it is equal to 20.02 lakh is answer to question number 1 of the question, part 1 of question. Index cost of acquisition is 20.02 lakhs. Likewise, index cost of improvement is equal to cost of improvement multiplied by cost index for sale year divided by cost index for improvement year. Since base year 2001, but improvement year is 2010-11, so whichever is later. So 12.06 multiplied by 280 divided by 167, it is 20.22 lakhs is index cost of improvement. So total index cost is equal to index cost of acquisition plus index cost of improvement, 20.02 plus 20.22, it is equal to 40.24 lakh is answer to part 3 of the question. Then taxable capital gain is equal to sale price minus total index cost, sale price given in the question. This we have calculated in last slide. So 83 minus 40.24 lakhs is equal to 42.76 lakh is taxable capital gain. So if seller is an individual, then 20% of this amount is capital gain liability, capital gain tax, and if he is a company, then 40% of this amount is capital gain tax. So in first case, it will be 8.55 lakh. In case of company, the capital gain tax liability is equal to 17.10 lakh. Answer to part 6 of question. An individual owned property was originally acquired on 1st October 1972 for rupees 45,000. The fair market value of the property as on 1st April 2001 is 5.25 lakh. On 1st April 2017, this property was sold for a sale consideration of 25.05 lakh. 100 to 72 are cost index for 2001, 2017, 18 respectively. Calculate index cost of property and capital gain. So property was sold on 1st April 17 exactly. So this is a exact date has been given. So 25.05 lakh was the selling price, and property was acquired on 1st October 72 at a cost of 45,000 rupees. And fair market value of the property was 5.25 lakh as on 1st April 2001. Cost index has been given in the question, 100 and 272. So again, first we have to see what was the date of sale of the property. So here, property was sold on 1st April 2017. So it is exactly one day after 31st March 17. So base date for valuation is, in this case, is 1st April 2001. Since the property was purchased before base date for valuation, which is 1st April 17, thus cost of acquisition is equal to actual cost of acquisition or fair market value as in base date, whichever is higher. So both these figures have been given in the question. So thus cost of acquisition is 5.25 lakh. Thus index cost of acquisition is cost of acquisition multiplied by cost index for sale year divided by cost index for acquisition year or base year, whichever is later. So here base year is later than the acquisition year. So that means 5.25 multiplied by 272 divided by 100 is 14.28 lakh is the index cost of acquisition. Answer to part 1 of question. Likewise, taxable capital gain is equal to sale price given in the question is 25.05 lakh minus total index cost calculated here 14.28. That means taxable capital gain is 10.77 lakh. Is answer to part 2 of question. So that's all in today's session. So before I'll tell you what we are going to have in next session, I would request you to please subscribe to this channel if you have not done till now, and please click on bell icon so that you will be notified about next session I'm going to upload. So in next session we are going to discuss examples and case studies on cost index method. So 12 marks case study, up to 12 marks of case study may come out of it. So we'll try to have a small session on this thing. 2-3 examples we'll try to cover in next session. Important and interesting session. Thank you.